Hello, my fellow investors, and welcome back to another fundamental analysis video. Seeing that, guys, we're really done with with earnings for this quarter. I figured let's take on your guys' recommendations. So, like always, let's bring on the wheel. You guys know it, you guys love it. Let's bring on the wheel. Let's spin it and see which stock, which was recommended by a comment, are we going to analyze today. There it is, SMPL. So SMPL was brought up by none other than, of course, it had to be Tony. Of course, it had to be Tony. So it's brought up by Tony, and I'm going to pull up the comment right here so that way you guys can see. And yeah, guys, let's take a look at this company, SMPL. Take a look at what they do. Take a look at their fundamentals, see their charts, and then do a discounted free cash flow approach to see if this company is a good price to buy or not. But before we get started, make sure to like, subscribe, comment. Really does help with the algorithm on YouTube, as well as make sure to follow us on SMPL Investing. And if you'd like to join the Discord, the link is in the description below. So with that said, let's get started with this analysis. So guys, here we have the company Simply Good. Really interesting company. They just, well, actually, by the looks of it, is that no way they own Quest. Okay, now I'm already interested in this because I'm a really big fan, not so much of the Quest bars, but I really am a big fan of the chips. The chips are absolutely amazing, especially for me, because I love doing keto. I've been doing keto for like 7 years now. So I'm actually really interested in this. I'm actually really interested in this now. The one thing though that I do have to say is that this is very expensive. Like these foods, the Atkins, the Quest bars, like the Quest chips, very expensive, right? Very expensive. So I look at this and I'm like, I'm interested. But man, I want to take a look at these fundamentals. So let's actually get started with what they do to anybody who doesn't know. We got Simply Goods Foods Company operates as a consumer packaged food and beverage company in North America and internationally. The company develops, markets, and sells snacks and meal replacements. It offers protein bars, ready-to-drink shakes, sweet and salty snacks, cookies, protein chips, and recipes under the Atkins and Quest brand names. Absolutely love it. The company also provides confectionery products such as full-size and mini peanut butter cups and fudgy brownie and gooey caramel candy bites, chocolatey coated peanut candies, and coconutty caramel candy bars under the Atkins Indulge brand name. It distributes its products to various retail channels such as mass merchandise, groceries, and drug channels. Okay, guys, I mean, that pretty much sums it up. They make keto-friendly, or at least low sugar snacks. So if we take a look back at this, if we take a look at our brands, one of my favorite guys is Quest. And oh man, oh yeah, I really do like this. One of my favorites is the cookie. Oh my goodness, guys, the cookie's so good. The cookie's so good, and it's essentially like little to no sugar, right? So I love these things, man. But they're very expensive. I mean, you guys can see here that a box of 12 is $30, so it's very expensive. Still, though, I do love these products. I really do. So, man, I'm actually really glad that the wheel chose this. So with that, let's actually now hop into their earnings, because they had earnings on June 27th. And we can see here that the EPS normalized actual came in at 50 cents. That was beat by 2 cents. EPS gap actual 41 cents in line. And the revenue missed by $2.77 million. The revenue was essentially $334.76 million. Now, the next one is going to be on October 18th. And we can see that the EPS normalized estimate is still for 50 cents. The gap estimate is still is going up by 42 cents, and the revenue of $374.52 million. That is just an estimate, but out of 8 revisions, 5 of them to the downside. So yeah. Now with that, let's actually jump into the calculator. We got the ticker for SMPL, market cap of $3.27 billion, a PE of 22.53. Current share price of $32.66. Now, this is actually a really interesting one because, as we can clearly see, they're down on the 1 year 1.45%, and on the year to date, they are down 17.53%, very near that 52-week low of $30 on the dot. And also, guys, they do not pay out a dividend. Just on Friday alone, it fell almost 3%, 2.91% to be exact. Now, something else I forgot to mention is that, well, they essentially were founded in 2017. And this is important for all the fundamentals that we are going to see in just one second. Nonetheless, though, coming back over here, we can see that they don't pay out any dividends, which means all of the free cash flow is going straight into themselves. And we can see that the cash flow is going up 63 million for the 10-year average, and the last year's free cash flow, it is $159.5 million. I like to see it, but let's actually see the trend and see how this is actually going. So let's start off with the net income. We got 10 years ago of negative $8 million, guys. 1 year ago of $133.6 million. Now, full stop. They were founded in 2017. So basically right here, right? 7 years ago. Now, here's the thing. I understand that we do have negative numbers here. Even as of 5 years ago, we do have negative numbers, right? So I look at this and I'm like, all right, this is a little bit confusing, I guess you could say, because this is a very, very new company, right? I mean, we got 2023, 2022, 2021, 2020 was 4 years ago. So 2019, the fact that this is in the negatives, don't really know why when it comes to this. Would expect this, 2020 or maybe even 2021, but it does seem to be that as of 4 years ago, they are in the upwards direction. So I look at this and I'm like, 65%. This is an increase on the 10 years, guys, of 1,770%. Again, 65%, mainly because there's a lot of junk going on over here, but as of recently, you guys can see that they are uptrending. So 65%. Now, the free cash flow looks a little bit better than that of the net income. Still has some negatives though, but a lot less. We can see here $29.1 million 10 years ago to 1 year ago of $159.5 million, increase of 448% with an average of $63.01 million. The only 2 times here where they were negative was 8 and 7 years ago. Aside from that, okay, they did have a downturn 4 years ago. I would say COVID related, right? But aside from that, it doesn't look too bad. I would say COVID related 4 years ago and then interest rate related 2 years ago. That's what I'm going to give it, guys. 70% It is a little bit better than that of the net income. Now, the revenue. Okay, this is actually pretty confusing because we got 10 years ago of $379.3 million to 1 year ago of $1.24 billion. The reason why I'm saying this is a little bit weird is because they didn't have any revenue in 8 years ago. I don't know what happened here. So I look at the revenue and I'm just like, okay, now this puts into question the free cash flow 8 years ago and then the net income 8 years ago. So I don't know. But I'm going to take it from the 5 year ago mark. Take 8 years ago as an outlier. Don't really know what's happening there. I'm going to say, guys, 80% when it comes to this one. That actually doesn't look too bad. Now, the assets as a reference only, here you guys have it. The liabilities are interesting because you guys can see that as of 5 years ago to now, it's actually decreasing, while the assets 5 years ago till now are actually increasing. Love to see that. Really, really love to see that. Wow. And the assets minus liabilities, it's looking really good. Like it's consistently going up at a pretty good rate. Aside from the 10 year ago to the 9 year ago, actually, never mind, that is still going up, right? Negative 27.8 million to negative 5 million. That's still going up. All in all, I do like this. Average total assets of 1.5 billion, liabilities of 524.52 million, and the difference of $971.44 million. I'm going to have to give this, guys, 85%. No, actually, no, I'm not going to get 90%. I do like this. And the fact that the liabilities are decreasing as the assets are increasing, that's actually really, really good. Now, cash flow minus the liabilities. Cash flow is also increasing, but the liabilities going down is even better. We can see here that from 10 to 7 years ago, going up. Really, really good. They came down 5 and 4 years ago. Okay, perfectly understandable. COVID, let's just assume it to that. And then from essentially 4 to today, that is nicely increasing, going back to 0. Guys, the average is negative $464.73 million. The 1 year ago value is negative $332.8 million. Lower than the average. Love to see it. I'm going to have to give this, I'm going to say a 95%. I do like it. It's a 95%. Now, the shares outstanding. This, guys, is a brand new company, right? Newer than most other companies, right? In 2017. So I look at this and I'm like, yeah, I kind of understand them issuing shares. They should be issuing a lot of shares. And you guys can see the 10 and 9 year ago value being the same. I had to make that So that way the numbers would make sense, as well as the 1 year ago to the trailing 12 months. I made it the same. Nonetheless, though, that's 11.8 million shares to the day of 100.1 million shares. That's a big increase of 748.31%. Previous year to the current year, just looking at 2 years ago at 99.6 million shares to today of 110 to today of 100.1 million shares, increase of 0.5%. We can see that they have been increasing essentially every single year at around 0.5%. So I look at this and I'm like, yeah, this 10-year value or this 10-year increase is because of this, right? It's because of this mainly. I don't see this as too big of a deal, but I still don't know where it's going, so I'm going to say 50%. Yeah, I'm going to say 50%. And lastly, cash and equivalents. They currently hold $208.7 million with an average of $114.36 million. When it comes to the overall grade for me, guys, it's a 73. It barely passes the mark of what I like. My biggest issue when it comes to this is not necessarily the fundamentals. It's the fact that it's so new, right? It's the fact I love their products. I like their fundamentals. Their fundamentals are good, but I would actually argue there's still a little bit of a risk, not entirely like a full-blown risk, like some other companies out there, like for example, like a Rumble. No offense to Rumble, but you know, this one is a little bit less of a risk than that of Rumble, because Rumble we don't even have. I think we're about to get 5 years of data just this year, whereas this one we do have a lot of data to work with. So I'm looking at this, I'm like 73% does make sense. Still be a little bit weary for the fact that it is a rather newish kind of company. All right, and now taking a look at the discounted free cash flow. I had to mess with the numbers a little bit due to the fact that the 1 year that we had zero revenue, I had to make it, guys, the same as the previous year. So sorry for that. It's just the way that it is. Sometimes that happens. So we take a look at this. We got $16.96, not adjusting for debt, and then $18.37 adjusting for debt. In the past 10 years, every single year, when it comes to the revenue, they have increased at around 15.54%. However, they have issued around 59.53% of shares every single year. So when it comes to the revenue, let's just say very simply 8, 10, and 12%, right? I'm going to go really conservative when it comes to this. Now for the predicted share buyback. I'm going to have to say that they're going to continue to issue. I'm going to have to say that they're going to have to continue to issue because I don't see the reason why not, right? They may be getting buyback. I don't necessarily know. They are doing pretty good free cash flow, so I just do not know where to put this. But I'm going to say issuing at around like -5. For the lowest, let's say -3, and then let's say -1%. I think that's fair. Now for the required rate of return, this is not a company that I see gaining too much. I really don't. So let's just say 10%. And yeah, this is kind of the problem, is that $6.95, not adjusting for debt, to $14.04 on the highest assumption. From the lowest to the highest assumption, and then adjusting for debt, $7.81 to $15.31. Margin of safety 5, 10, 15. $6.64 to $14.54. So a lot of you guys may be like, "What? No way! What?" This is, guys. This is not saying what the stock price is going to. For all I know, the stock price could be $100 by tomorrow. I don't know. Right? I don't know. This is basically telling me what the company should be worth based off of the fundamentals, and what future projections we get based off of the past. Obviously, it doesn't need to follow that, right? For all we know, the company may do something along the lines of like 15% on average in the next 10 years. So if we were to do that, let's actually put 15% for the median. Let's say, I don't know, 13 for that one. And then let's say another 2. So let's say 17% when it comes to the revenue. And we can see that now it's making a little bit more sense in regards to this number, right? We saw that the lowest point was around like $30 when it came to that 52-week low. So I look at this and I'm like, it really just depends as to what you believe. And also the required rate of return. This is not a big company. I don't expect a lot of returns from them. 10% to match the S&P 500. On the high end, 7% to match it on the low end. Look at that. You automatically reach that $39.13 on the high end, where we're at $32.66. We're basically, based off of these assumptions that I just put in right now, we're essentially between the median and the high assumption. It all depends as to what you believe the company will do in the future. Every investment is the present value of all future cash flow. So make your own assumptions for yourselves. The calculator is available for free. At least the 5-year one is. And the 5-year one may come up with different numbers because there's obviously less of a time scale there, right? 10 years is a much more heavy time scale. So yeah, make you guys your own decisions because at the end of the day, not financial advice. And again, every investment is the present value of all future cash flow. I'm not here to make that decision for you. I have no idea why this company has zero, revenue in 2017, 2018, whenever that was, 2016. That's for you guys to determine for yourselves, not for me. I'm just looking at the numbers, giving you guys my general wide carpet view on this type of company. So yeah. And with that, this is essentially my kind of prediction as to where the company should be valued at right now. All in all, I really, really do like this kind of company. As I said, I love the Quest brands. I really, really do. My issue mainly is well, I mean, what price are we paying for this? And of course, the risks associated with it. But I do like them. And I don't know, maybe more and more people will begin eating less and less sugar. So, yeah. Anyways, guys, that pretty much does it for this video. Make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. Make sure to follow us on XFL Investing. And if you'd like to join us on the Discord, the link is in the description below. You guys can see I am taking your guys' recommendations for the month of September because, well, that's it. Earnings is done. And beginning of October, we got earnings again. So that's always fun, right? That's always really, really fun. So if you guys want your recommendations, I'll put it on the wheel. Comment it in any of my videos. Comment it, and then I'll put it on the wheel, and hopefully they get chosen. Anyways, guys, with that said, peace out, and we'll see you all next time.